Are you taking too much risk in everything you do? What about being so conservative it feels like you're in the movie Pleasantville? Am I aging myself yet? What if I told you there should be a healthy mix when investing in the stock market? Hey there, my name is Anthony and welcome to Growing Your Wealth. First off, I'm a sinner redeemed by Christ. I'm a husband, a father, a student ministry volunteer, photographer and videographer by trade, and a stock market enthusiast. The reason I'm making this channel is to bring glory to God while helping others become good stewards of the money they have. Proverbs 21:5 says, "The plans of the diligent lead to profit as surely as haste leads to poverty." We can all use a little bit more diligence in our life, me especially. I'm glad you're here and hope you receive value out of this educational content. I look forward to building a community where we can discuss all things growing your wealth. Check this out. Here's a rule we shouldn't forget. Rule number 1, never lose money. Rule number 2, never forget rule number 1. So, what is risk tolerance? Well, the U.S. Securities and Exchange Commission, or SEC, defines risk tolerance as an investor's ability and willingness to lose some or all of an investment in exchange for greater potential returns. It is composed of two main elements. You have risk willingness. This is your psychological comfort level. It's your subjective emotional comfort level on how much loss you are willing to see in your portfolio before you panic and sell everything and potentially lock in those losses. And then you have risk capacity, or this is your financial ability. It's your objective financial ability to take on risk. How much loss can your financial situation afford to absorb without derailing your critical financial goals like retirement or a down payment of some sort? Here are some key factors that influence your risk profile. Your personal risk tolerance is not a static number. It is influenced by several factors unique to your life specifically. Here are 5 categories that determine your risk tolerance. You have the time horizon, your financial goals, age, your financial situation, and your personality. I'm going to give you 5 examples in those 5 categories with a high risk profile and a low risk profile, and you can check off which one suits you best. All right, let's look at time horizon. Say you're a young person and you have many years ahead of you. You're able to have a little bit more of a high risk tolerance or aggressive investing behavior. You can technically play the long game. Hypothetically, you wouldn't need the money for 15 plus years and you have time to recover from downturns. You can classify this as a high risk time horizon. Now let's look at a low risk tolerance. You may need the money in, 5 years or less? Let's say you're saving for a down payment on a house of some sort. You'll have less time to recover from those losses, so you'll need to maximize your gains while minimizing your losses. You catching on? Hopefully you are. If not, comment on the video and I'll do my best to respond. All right, let's look at your financial goals. High risk behavior allows for seeking maximum growth and willingness to accept volatility. A low risk tends to seek capital preservation or wanting to keep the money safe with modest returns. How about your age? High risk might typically be for younger investors, as they have a little bit longer earning lifetime ahead of them. Low risk, well, that typically tends to be older investors or anybody who's nearing their retirement and relying on their portfolio for income. What's your financial situation like? High risk could lean towards a higher income bracket. Maybe you have substantial savings, low debt, or a large diversified portfolio. Low risk may qualify you to have limited savings, high debt, or unstable employment or income. And finally, you have your personality. High risk generally focuses on being naturally calm and composed when viewing large paper losses. You're more comfortable with uncertainty. Low risk, well, you might be anxious or prone to panic selling when the market drops sharp. Now let's understand how your risk tolerance impacts your portfolio. Once you determine your risk tolerance, whether it be aggressive, moderate, or conservative, it dictates your asset allocation. Asset allocation is the mix of different asset classes in your portfolio, primarily between stocks. These tend to be higher risk, higher potential return. You have bonds, which are lower risk, lower potential returns, often used for stability, and then you have cash and cash equivalents. These are going to be your lowest risk and your lowest return. Let me use an example of a risk profile with an aggressive, moderate, and conservative view. Aggressive could look something like 80% stocks and 20% bonds. Moderate could look 50% stocks and 50% bonds and cash. And then conservative could look like 20% stocks and 80% bonds and cash. Understanding your risk tolerance is crucial because it helps you select investments that will allow you to sleep at night and prevent you from making the irrational, costly decisions like selling everything during a market crash. Now I want to hear from you. What is your risk tolerance? Are you aggressive, conservative, or have a smooth blend of both? Let me know in the comments below, and I will see you in the next video. Happy investing, and may God truly bless you.
But yeah, you should be good. So. But just let me know when you're ready.
Oh, is it still recording?
Yeah, it's still recording. So I'll just let it roll.
Okay, yeah.
So
All right.
I don't have to.
Yeah, I'm good. Yeah, I'm good.
Okay.
Let's go.